Okay, folks. Good evening, good evening, good evening. It looks like we are live on Facebook right now and excited for that. Going to be jumping on real quick. This will be a very short and quick session. Just looking to provide value for everybody. That's what we do. And just want to make sure that we have the opportunity to do that. And so what we're looking to do real quick is essentially just do a 10-minute session where we're doing a quick little tip on Forex. So today's session, this is going to be a series that we're going to start doing on a regular basis. So today's session will be very simple. I'm going to go ahead and use my trusty little pen here so we can mark on the screen. And we're just simply going to talk real quick about risk management. Okay, risk management is super important when it comes to trading because I think most people, their trepidation, their fear, if you will, for even looking to take on managing their own money and trading their own money is that they're going to lose it all themselves. Excuse me, and especially their fear of the foreign exchange market from what they've heard is that you can lose everything and you can go completely broke. And yes, you can if you don't use risk management. So for those people who don't use what's called a stop loss, who trade without that, the possibility for a dramatic swing in the market is always prevalent. And so you could potentially lose the money that you have. But what we teach you is the responsible way to trade. And what we teach you is something very simple, which is that we want you to risk between 1 and 3% of your account. Now, that means at any time you have between 1 and 3% of your total value of your account out in the market at any one time. So if you have one trade at 1% and another trade at 2%, that's 3% in total. That means until those trades either hit take profit or hit your stop loss or whatever point you exit the trade, you couldn't enter any more trades. You have 3% total. If you have one trade that's trading 3%, that's what you're trading, and you're risking just 3% until that trade finishes its course. If you have three trades out at 1%, you get my point, right? So the idea behind that is if you're trading that way and you're using a stop loss, then that means that you can never lose your whole account on a single trade, okay? And so what we're doing is just sort of demystifying that from you, taking away that myth that you have, that sort of trepidation, that fear that you have about the market, because it's not prevalent if you use a stop loss and proper risk management. So with that being said, I'm going to share my screen real quick, and we're going to jump into, and those who know me, this is one of my favorite topics in the whole world, is how to have proper risk management. So here's what we got. So first thing is real simple, and we're going to use simple numbers. If I have an account that has $100 in it, okay, 3% of $100 equals $3, right? That's 3%. Okay? So what does that mean? Well, it means that if I was trading a $100 account, I have several options. If I really am comfortable with my trade setup, I like the entry that I have for my trade, what I can do is I could then enter a trade with a 10 pip stop loss at a 0.01 lot size, which would equal $3, or excuse me, at a 0.03 lot size, excuse me, would equal $3, okay? So if I had 10 pips at 0.03, I would hit my stop loss and I would lose my $3. That's my risk, right? This is the max that I can risk. If I wanted to put my stop loss at, say, 15 pips, right? Then I could do sort of a 0.02 and I would also hit my $3 stop loss. And if I needed a wider range, I wasn't as comfortable on my entry price, or maybe the pair is a little more volatile, I would put my stop loss at 30 pips, then I would use a 0.01 lot size. What does that mean for you? Well, if you're looking at a trade and you're looking to enter a trade and your account is at $100, which means that your maximum that you could lose at 3% is $3, and the stop loss requires you to be greater than 30 pips, then that is not a trade that you should enter. Even if it turns out that that trade never goes 30 pips in the negative and ends up taking profit, you still made the right decision. And the more often that you make the right decision, the more often you have the chance to be profitable. And so what you want to do is make sure that you're minding your situation when it comes to your risk management. Am I in this trade, and am I using the proper amount of leverage, and am I making sure that I don't have more than my 3% at risk? If you do this, then you can trade and trade and trade and trade and end up being a profitable trader, in my most humble opinion. And so for those of you who are on this live right now and you're not sure exactly what stop loss means, or pip means, or you're a little, you don't know what risk management or some of these things, lot size, and some of the things that we're talking about, those are things that you would be able to get an education on in our academy. What I'm doing here is just giving you some basics, giving you some simple things so that you can begin to understand that trading isn't as difficult as it seems, that trading doesn't come with as much risk as it seems, although trading is risky. You can lose money in the foreign exchange market. Past results don't guarantee future success. And we want to make sure that you understand that there is risk involved with trading. What the academy does, they don't trade any of your money for you. They don't touch your money at all. That's between you and the broker that you choose. But what the academy does is give you an education and also teach you about risk management so that you can make the decision for yourself whether or not you want to trade and be conservative and do the number one goal that you have as a trader, which is not to make money, but to protect your capital, which is the balance of your account. Okay? So that right there is just giving you a little bit on risk management. Again, we want to look at 3% of our account out at any one time. You can break that down in a variety of different ways, but the idea is that no more than 3%. I'm going to throw you in a little free bands here. And what I will also say is that if you feel that you have some other trade setups, it is possible to have more than one live account so that you could have a trade for worth 3% in one account. And then when you see another trade set up, 3% in another account. So you could have multiple accounts, which would allow you to have a few different trades going on, okay? And then the other thing, last tip for the day, is that if you lose 5% of your account in any one day, so basically 2 trades, that means you could lose up to 6% if you had 2 3% trades. You shut down for the day, you pack it up, you analyze those trades, go back in the academy, learn where the hole in your boat was, what caused that trade to go wrong, and you can then begin to fix those holes in your boat, and you can become consistently more and more profitable. But here's the thing, you don't want a revenge trade. You don't want to keep going and going and going. You want to get in the market, learn your lesson, get out, and call it a day. So folks, if this made any sense to you, if you see this on our YouTube channel, if you see this on my channel, if you'd like to get some more information on how to trade and what's involved in trading, you can hit me up directly if you're on Facebook. If this is YouTube, please leave a comment. below, and we will make sure that we plug you into the right information and the right training so that you can begin to get an education in the foreign exchange market. That's my time, folks. You guys have a great evening, and let's have a great week in the market. Ain't it great?